Let me now bring on board Prabhat Avasthi, Head of Equity Research and Managing Director with Nomura Financial Advisory. Prabhat, good morning. Thank you for joining us. Prabhat, when we started the year 2013, things were looking rather charged up for Indian markets and things were looking rather weak for global markets. But if I map this year's performance, it's quite ironical. India is underperforming global markets, and globally, markets are moving from strength to strength.
Ironical in the sense that if you're really expecting India to continue to outperform, then yes. But otherwise, I think, we had a great year last year. We moved from a risk off to risk on, so India benefited more than the other global markets. Really speaking, the data points on India have not been great. The growth has not been strong. Current account deficit numbers have been poor. Currency has been weak. And on top of that, you have clearly oil prices now at $118, which also don't give too much of room for comfort. And finally, I think valuations have gone up a lot compared to, again, global markets. On the other hand, global market data points have improved. So if you look at data in China, in US, or even in Europe to that extent, there has been no further hemorrhaging. So frankly, I think reversal of market performance has to be seen in that context. Fundamentally, I think data points in India have been weaker than expected. The earnings season, you would agree, has not been great. You have seen several disappointments, and the companies which have performed well have probably only sort of met the expectations. So earnings season have not been also very strong. So I think that sort of was to be expected. And finally, I think there has been a lot of paper supply which has also come through, again, which is expected to continue, and that is soaking up a lot of demand for Indian paper, and that is also an overhang on the markets.
Prabhat, many experts are of the view that this year's budget will be more like a no event. The tone of the budget is already known, and the fact that Finance Minister has alluded to FY14 fiscal deficit number, we pretty much know what will happen to the budget speech.
I don't think it is a no event. First of all, it is one of the more important budgets. One, because of the fact that it is sort of, we are going into this election, into the budget before election, so this will be the last budget before the elections. Secondly, fiscal, how the fiscal deficit number stacks up, you might know a number, but the believability of the number and the means to get there will be equally important. Equally important will be the fact that we have seen a significant deceleration in investment cycle, and what does the budget do to improve that? I'm not saying that budget is end all of policy, but it is a statement of financial. It's a government's financial statement. And to the extent that our economy is facing as many difficulties as it is, I think it's a fairly important one. And as I said before, I think one must keep in mind this is happening before elections. So how does the math stack up in terms of the political sort of need of the hour from the ruling party perspective and the economic need? I think that will be equally important. So I think it's an important budget. I don't think really it's a non-event at all.
But in general, do you believe the rebound in real economy, corporate risk appetite, revival of the investment cycle will lag expectations and markets will be disappointed going forward?
So we've been saying that for some time. It is already evident, right? If you look at capital goods stock today, if you look at all the companies in infrastructure and construction, look at the stock prices. They really ran up, last year, but they have come back down to where they started from. So clearly there has been a disappointment in terms of earnings, which markets takes cognizance of. So first gets excited about a concept, and then you have reality, and that sort of tempers expectations. I think the reform process has well begun, but the fact that we had a very slow last 3 years will continue to impact the cycle. And I think the expectation of a growth revival, have built in, because numerous people have been writing about reform process and how quickly that can impact growth. I think that might be in for disappointment. I'm not for a moment saying that this is not a good start, but one has to be very clear as to how much lag is there, and I think the lag might be more than what market expected initially.
Prabhat, what is it that you're hearing from the FII crowd right now? We've seen inflows of $7 billion, but do you think some of them are parking money aside for the government paper?
I don't think so. I think this is, first of all, the inflow into equities is a broad phenomenon globally. I think there has been allocation away from debt to equity. There have been, obviously as the risk has waned, global financial risk that is, emerging market flows have increased. So India has obviously been a bigger beneficiary of these flows compared to other markets, but other markets have also seen flows. So this is a global phenomenon. And obviously because of the fact that India at the margin has more positive things in terms of reform process, there has been more flows into India. So I think the inflows to that extent are more a function of both global risk on and India's own reform process. I don't think people are saving money or the investors are saving money separately for issuances. I think they sort of react to these things as and when the issues come up.
Prabhat, I was just looking at your strategy report for 2013, and as a house, you're negative on cement. Why exactly are you negative on cement? Because that was one overweight call, from Nomura for 2012.
That worked, and I think this is also working. So I think
so far it's
that
working.
Is because Nikunj. I think the issue essentially very simply is that government is in a contractionary mode fiscally, so they are going to spend less, given that they want to control fiscal deficit. And the investment cycle is not going to pick up anytime soon. So our expectation has been that the growth rate as far as the cement demand is concerned will be weak. Now if you superimpose that with the fact that you had a very strong pricing environment last year, and the fact that sector is still running a fair amount of capacity underutilization, doesn't make for a great picture as far as investment cycle is concerned. So your hope essentially to buy cement stocks has to be that they will be able to maintain or improve the pricing despite a weak macro environment, which I think was anyways built into the valuations. The valuations are not cheap when we start the year, and therefore you obviously had you had room to some disappointment in terms of stock price performance. And finally, last year, if you remember, a lot of people played cement as a defensive because these companies had a lot of cash. They were while they were not, the volume growth was not, well, it was okay compared to today, but it was not as strong. But there was massive amount of cash generation, and that was good in a time of uncertainty as far as when the global financial risk was high. But that also has disappeared. So from the perspective of being a pure defensive play last year and the slowdown, I think that was our call, that it doesn't make sense. And I think lastly, you have some negative news on royalties, etc., also in the sector, which has also impacted performances. But the valuations were so rich that it sort of didn't make sense to continue to bet on the sector in a slowdown period.
Prabhat, do you worry about consumers slowing down? HUL has reported poor volume growth for the quarter gone by. Jubilant Foodworks has indicated that same store sales will be flat, and Happy City has indicated that same store sales are also flat. Do you think consumers are slowing down and they will slow down further?
Well, they were bound to slow down. In fact, I think that is one of the themes we have talked about in our report, because end of the day, again, if the government is going to raise, finally, sort of go into a fiscal consolidation mode, what all does it entail? It entails raising diesel prices. It entails, if you want to reform electricity sector, it entails raising electricity prices. It entails raising, fares, railway fares. So if you have to create room fiscally, then you have to ultimately reverse the process of, the fiscal sort of, I would say, shielding of consumer, or even giving more money to consumers through various schemes. That has to be reversed, and that essentially means that the disposable incomes will not be as strong as they have been. On top of that, you have other macro outlay of slow growth, which basically means the job cycle will not be as strong as it was in the when our economy is growing at 8 to 9%. So you superimpose the two, I think at the margin you are bound to slow down. The impact will probably be higher at consumption on discretionary side. It will be lower at the consumption on non-discretionary side, and which is exactly what you're seeing. So I think the fact that it will be a slow year for consumption, I think is very much on the cards.
Prabhat, you're bullish on M&M. What makes you A, positive on the stock, and B, what catalysts do you think are going to drive the stock outperformance from here?
Well, I think that is our bottom of call by the analysts. It's a cheap stock compared to the rest of the stocks. It's more based on rural economy. We are still more positive and constructive on rural side of the economy. And frankly, between that and valuations, it probably is still a good bet.
Do you think Indian markets, Prabhat, then are stuck between rock and a hard surface? One side, it's the consumption cycle which is slowing down. Other side, you've got the investment cycle which is yet to pick up.
Well, I think, the short-term prognosis of economy, if the fiscal side and reforms are taking place, might not be that great, but in the longer term, it will, you needed the bitter pill to sort of perform in the long term, and I think that is exactly what's going on. The impact of this bitter pill will be obviously over next 1 year, so might remain not very good for investors' palate. But you recognize that you're probably laying the foundation for a much more solid growth, because where a current account deficit was reaching and where fiscal deficit reaching, the market performance would have anyways been much worse in the long term if these reform sessions are not taken. So to your question of rock and a hard place, I think in the short term you probably are going to see slow growth, you're going to see poor earnings, but it is part of a grander design which might eventually lead to positives. But as far as the short term goes, clearly there are going to be headwinds. And the last thing I would say is that the commitment to continued reforms is absolutely necessary, because our macroeconomic issues are not yet fully sorted out. Our investment cycle is still poor. The implementation of reforms in terms of follow through to, for example, petroleum subsidies, which are principally, it's been said that diesel prices will eventually rise to market, etc., should be followed through. So follow through is very necessary. But all the impact of that, if you're going to have that sort of cut down of the last 4 years of fiscal loose policies, will be negative in the short term as far as growth is concerned. On the other hand, I think you might start getting in a zone where the interest rates start to come off eventually as the fiscal process becomes fiscal deficit comes down. So that is how market will play out. So I don't think it's rock and hard place. It's just that you might have a bump if over this year, etc. Maybe next year things will be better, but we'll have to watch the reform process very closely.
Prabhat, what about IT? Because HCL Technologies remains your top pick in the IT pack. What makes you so confident that we will see earnings visibility from HCL as opposed to its peers?
Well, I think there are two reasons for our bullishness. One is that it's not an expensive stock compared to the peers. Secondly, it has been outperforming for a while. We believe that their business model is robust in terms of the areas they address, their win rates. So it's again, there is our analysts just think that they'll continue to outperform as they've been doing for a while now. And the stock price, is not expensive at all compared to the kind of earnings they'll deliver. And I mean, from a strategy perspective, I'll say that technology has been one of our hedges against rupee, and that continues to be so. And again, if the globe recovers, then obviously IT will be very well placed, because its external demand and rupee hedge, etc., I think sort of works very well. So and finally, I will say again, even the whole IT sector is not as expensive as it used to be if you go 2 years back, but HCL is obviously quite cheap compared to the rest of the frontliners in the sector.
Final question. I know I've extended my appointment with you. Give me one name or maybe two names where you are advising your clients to allocate disproportionate amount of money, let's say 5 or 7% of their total portfolio.
To tell you the truth, I think we are saying that there will be the fiscal process will definitely have to move forward. I mean, that I think is the theme, because we are in a place where you cannot do cannot do without reforms. We'll have much more serious implications for the economy if we don't sort of move forward with the process of fiscal consolidation. And that reform essentially means, in our view, and the second thing is supply side reforms so far as energy sector is concerned. So we essentially have taken a call that over the next 2 to 3 years, the government will have to get dynamic of supply side response on the energy side, right? And that essentially plays positively into the energy sector, which is an overweight for us. I won't go into sort of absolutely the absolute claims. What you can see from a report that we are tending to favor at this point in time some asset owners in infrastructure sector, and also some of the energy stocks, because without reform process, I think it'll be very, very tough to move forward so far as Indian economy is concerned. And a lot of our problems on current account and fiscal side are all springing from the fact that we have massive energy deficits both on coal side and oil side. So something has to be done about that. I think that is a call we are taking over the next 2 to 3 years.